Good morning, everyone. Welcome to BodhiBrew, offering advantage through insight. I'm your host, Kong, Creative Director of Bodhi Research Group. In today's episode, we cover outlines for natures of PnL with our operational advisor, Matt Tambelini, and John Soukous, the CEO of Quan Capital Advisors. We delve deeper into analyzing financial markets, exploring how much dollar profit and loss investors can extract from the market. Before founding Quan Capital Advisor, John Soukous was a portfolio manager and a senior member of Wellington Management's global fixed income and hedge fund business. He is an experienced leader and investor with a proven track record in developing and implementing quantitative macro investment strategies. So, sit back, relax, and enjoy a cup of brew with us.
Hi, everyone. Thank you for joining BodhiBrew. Today we have John Soukous. Looking forward to an interesting discussion, John.
Thanks, Matt. Yeah, same.
So I heard you speak once before. Very, very interesting discussion. And I think it's something that the industry, specifically the alternatives industry, struggles a lot with. And so I'll leave it to you to broadly define what the topic of today's discussion is. But I think in general, it's how big is too big in the hedge fund space? And is there a limit to the P&L that managers are able to make in the space?
It's an important topic. And I think one of the big challenges with these types of questions is that there just isn't a lot of public data available to assess it. So we're really dependent on internal data, anecdotal evidence, conversations with other people, managing teams. So it's really difficult to be conclusive and 100% certain on various outcomes. So, and everyone likes things to be perfect and stitched up. But given my own experience, this business is tough. It's really, really hard. And, you're competing against the best, and it makes it very, very challenging to make big dollars. And I think, what's fascinating to me is when we think about returns, everyone's always thinking about things in percent. But really, the dollars are what matter. How do you extract dollars? And is there some capacity limit on those dollars? And the FT releases a report from LCH, I think, every year. And it looks at the top 20 hedge funds of all time. And it looks at their dollar value added, their dollar P&L. With some basic arithmetic, I looked at how long those firms have been in business and tried to come up with what's the average annual dollar P&L of the top 20 firms of all time. And surprisingly, when I ask people this question, what do you think that number is? Most people guess way too high. And the average for the top 20 funds of all time, I don't know how many standard deviations that is, but it's a lot, maybe it's 8 or 10, is about $1 billion. Wow. And what's interesting is that the deviation from top to bottom is actually pretty tight. And I think that number is just fascinating to me. Yeah. There has to be something there. And I know there's been some research outside of finance and biology that makes the case that for whatever reason, organism systems reach some limit, they can't grow infinitely, and it constrains how much they can grow, and in our case, how much money you make. What is the driver of that? It's a tough question, but there's a host of things. Size is a problem. Size is not your friend. Having more assets doesn't increase your chances of more P&L. I've never seen, in my experience, I've been in this business for 30 years, as people have gotten bigger, it's made it easier. It's just not the case. And, what is the force that causes that to happen? Transaction costs go up. I think that the market's very, very smart. The more people you talk to, the more people understand what you're doing. The street knows what you're doing. And all of that chips away at your performance. And, every day you wake up, I think the world's trying to make you average. It's trying to make you average. And, size isn't, it makes it very, very difficult. So as you kind of take this idea down a few layers, at the fund level, pick your number, but $1 billion seems to be the data, limited data would suggest that that's some natural limit. I've tried to think about it as, we have some natural law of PnL physics that constrains what people can extract from the market. But if you take this idea a step further, it's probably driven by a constraint at the strategy level. How much can an individual strategy generate in terms of P&L? And once again, in my experience and talking to people in the industry, $100 million per strategy is a lot. And very, very few people are capable of doing that on a consistent basis. So if it's really a strategy thing, then ultimately the constraint is talent, and talent is finite. And what we're talking about is like 0.001% of all risk takers around the world. The way I've tried to think about it, I played a lot of sports growing up. Like, how many Michael Jordans are out there? How many Tiger Woods are out there? How many Gretzky's are out there? Not a lot. Yep. So, I think, if it's a talent thing, that raises a lot of different questions for, our industry. If you're building a team, managing a team, starting a fund, how are you going to attract the next and retain the next Gretzky? So ultimately, I think it's about talent and a competition for talent. But those would be some of my initial thoughts on the topic.
So interesting, and so many different avenues we could take to explore this topic. I think we can both agree that, as you mentioned, there's not a whole lot of data out there on this, and so we're not going to solve this today. Yeah. There's going to be differing opinions on it, but I'm curious about maybe not so much the mechanical side of it, but more the psychological side. And given your experience as a portfolio manager, managing large pools of capital, your insight would be very interesting here. There's clearly strategies, micro cap equities, high frequency trading that are just inherently limited via some of the mechanics that you mentioned earlier, but also just the sheer size of the market not being able to support a ton of assets. Talk to me about, once you do achieve quote unquote scale at a fund level, whether that's $1 billion, $5 billion, $10 billion, how much more difficult is it to put a trade on knowing that you're putting $100 million of capital to work versus $5 or $10 million of capital to work?
That's a really important question. And this is something that, I'd love to explore more. If I was an academic doing research, it's a topic that I'd like to explore. There's been so much work done on behavioral finance and the psychology of investing and trading. And we see this a lot. Somebody starts out, they're young, they're doing well, great strategy. They get to a certain level. And then to make the jump from X dollars to primetime dollars, it's hard. People psychologically struggle with that leap because the losses are just bigger, and although I talk to people and say, look, just forget about the dollar numbers, just think about it in percent. Right. How many basis points are up today, or what percent are you up or down? But it's hard to mentally pull yourself away from that. And, like most things, it's there's a Pareto distribution, it's 80-20, 90-10, or 1%, 99%. I think investing is very much like that, but very few people have the psychological strength to do it. Because losing money is tough, and I think the challenging thing is, in this business, you have very little edge. And when you think about a very good investor, they would have a hit rate, how often you're right or wrong, of maybe 55 or 56%. So you're almost wrong most of the time, right? You're only right a little bit more than 50%. And most people in our industry are smart. Everyone's very smart. They've probably gone through school getting 90% on everything. Now, all of a sudden you wake up and you're getting 50%. Psychologically, it's very, very difficult. And, I joke around, but, you're getting punched in the face every day, and that doesn't feel good. So it takes a certain character to do that. And what I find interesting when you dig deep on some of this data is somebody like George Soros, for example. There's been data tossed around about his approach. And interestingly, Soros' hit rate, from what I've heard, was less than 50%. It was something like 47. So he wasn't even right 50% of the time. And he is, if you look at that table I mentioned earlier, one of the greatest investors of all time. And our industry focuses on the hit rate part. You go to conferences and you think about what's the next big idea, what's the next trend, but very few people talk about risk management, position management. And I think that because we want to be right, human beings like to be right. Investing is a super lonely endeavor because you're often sitting in a place where the market's telling you you're wrong. And so, what I find interesting is when we think about investing, we kind of look at these two metrics. One, hit rate, how often you're right or wrong. The other, win rate, which captures the size of winners versus losers. And that's interesting. You don't go to a lot of conferences where people want to talk about that kind of stuff. It's just not that sexy or interesting. But Soros's win rate was exceptionally high. He made a lot on his winners and didn't lose much on his losers. So he didn't have to be right 50% of the time and still made a ton of money.
Right.
And that's where you can apply science and data and analysis. And all you're doing is juicing up the ideas that you already have. It's not like you're being any smarter because we have very little edge on ideas. And again, I don't know what it is, but it seems like there's some, again, financial law of PnL physics that limits how right you can be.
Right.
You think about baseball, the top hitters are 300, right? So
Gets into the Hall of Fame.
and that gets you into the Hall of Fame. So the psychology part is, I think, super interesting, and helping people understand their biases, your own kind of limits on investing. That's an area I think that if I was running a business, I'd be spending more time on, is trying to help people get comfortable taking the big shot. And, again, I go back to sports analogies, but not everyone wants the ball, 10 seconds left on the clock to hit the game-winning shot. But guys like Jordan did, So it's a tough and stressful business.
So, John, just sticking with the behavioral side of things for one more question. I'm curious, it's understood that we all work hard in this industry, and in no way is anyone implying that that's anything but true. But I can envision a scenario where if we say $1 billion is this natural cap, just for discussion purposes, and we have a $10 billion fund, and we're making 10% a year, and we have our 2 and 20 or 1 and 30, whatever the fees are, that's a very nice business to run. And so I could envision a scenario where there's a complacency aspect that comes into it as well, with respect to, okay, I'm making my capital partners happy. I'm putting up a decent return stream. My team is very well situated from a financial standpoint. Is there anything to that psychologically where you just kind of get comfortable at a certain level, recognizing that you don't need, quote unquote, to make additional return?
Once again, I think, it's a great question and point. How do you get data on that? Are you feeling complacent? If you were to ask every portfolio manager, fund manager in the hedge fund business, do a survey, people are going to answer that, honestly anyways. But, human nature, fear, greed, right? I think that as you get more comfortable, I think about my own experience, the temptation is to kind of kick back. I think most of the people who are driven into this business, they're assassins. It's not necessarily about, the money. It's about the game and winning. But I would imagine that once again, the world's trying to make you average. There's a portion of people out there who are like, I've done pretty well. Do I want to wake up at 4 o'clock in the morning tomorrow? Maybe I'll just take a little extra time tonight. And I think about it myself. I used to get excited on Sunday. Markets are opening. I can't wait. I can't wait till they go to the office on Monday. And, the last year or so, which is part of the reason why I'm kind of retiring, is that, man, it's tough.
Yeah.
Right. And as soon as you step back and lean off the gas a little bit, somebody else is going to step in and run you over, so it's just imagine, think about it's the highest paid industry in the world.
Right.
People make billions of dollars a year. Yeah. As a result, you're attracting the most talented people in the world. And every day they're trying to beat you. It's a zero-sum game. Right. So, I think people get into their own little space and think, I'm just going to do this. But the market's smart. It figures stuff out. I hate to get technical for a second, but when you look at this hit rate, win rate idea, one of the things that I observe on strategies is strategies cycle. So, the hit rates kind of, you're 50-something%, win rate's pretty good. And all of a sudden, the hit rate starts going up and the win rate, your margin starts going down. And I think what's happening is the market is picking up on your strategy in some way, shape, or form. and hit rate continues to go up and the margins continue to go down. So in order to hit your return target, you have to use more leverage. Yeah. So eventually you hit a point where I've seen the win rates go negative, but you're right so often that you're still making money. Wow. And all of a sudden there's some exogenous shock. That strategy blows up, a drawdown. Everyone had a lot of risk and people blow up. And next thing you know, it starts to revert back to something more normal again. Yeah. So you see this kind of cycle I've observed in strategies. So the market's smart. You have thousands and thousands of people with PhDs and they're data scientists trying to figure this stuff out. So, it's competitive.
Yeah, yeah. I want to dig in a bit just to make sure that I understand the strategy point that you mentioned as well of $100 million, again, just for discussion purposes. When you say strategy, does that just mean kind of team within a multi-strat or is that fund or?
It's a specific investment thesis or hypothesis. Okay. An individual or a small team, they have a certain view on how the world works and they build a process around that and run that specific strategy. And, we've seen over the past, 10 years, the multi-strategy, multi-manager hedge fund has really evolved and grown. Yeah. And, diversification is your only free lunch. So it's not surprising, but, a lot of these large organizations have, 200 teams, 200 strategies. Right. But from what I've observed, there's only a handful that are given the risk to try to achieve those type of targets. So I think it's at the very specific strategy level. And as you mentioned earlier, some approaches that are, very RV, micro RV, there's more capacity constraints on that because it's difficult to move size around and you're probably exploiting some very small opportunity. But, you're trying to pull together a mix of all those different types of strategies, but that's what I mean.
Maybe we'll shift gears a bit to the allocator side of the discussion now, but obviously there's very large pools of capital that have very large amounts of dollars to put to work. Yep. They want to do that in as scalable of a way as possible, which implies that you would need to write relatively large tickets to underlying managers, which adds to their AUM and then increases the likelihood that they achieve this kind of cap, if you will, sooner rather than later. Have you discussed this concept with allocators and what do you see as them trying to solve for with respect to this kind of size problem?
Yeah, I mean, if we go back to the start of the discussion, I think that pool of talent is finite. Yeah. There isn't an unlimited amount of people who can do this. So if you're allocating, you're competing against everyone for those very talented people. So I think the big thing is, we're trying to figure this out. We don't have all the answers. We're trying to ask the right questions. And I think what I'm trying to do is provide people with a set of questions and a framework and a starting point to explore. If you're a huge fund, well, I'm going to ask myself a few questions. What is your PnL target in the kind of hedge fund space, the uncorrelated alpha space? What are you trying to make? And then how do you stack up against the 20 best firms of all time? Right. Because if you want to get there, you better have everything lined up. Yeah. Trading, research, execution, have the right mindset to deal with that. So the first question, and I've talked about this with, allocators, what's your PnL target? Yeah. How do you stack up? And then, kind of going down the list, as I mentioned, if you take this down a couple of layers, well, if you're allocating to a specific strategy, what PnL target do they have? How have they discussed their views on capacity? Mm-hmm. And what's the logic behind their view on capacity and their PnL potential? I think, again, it's a starting point, and we're just trying to get some logical answers and make sure that people have thought about it. Right. We've interviewed, I've interviewed a lot of people over the years, and it's one of the first things I ask, what do you think your capacity is? And I get some discussion about the size of the market. The treasury market is this big, therefore I can be $20 billion. I'm like, yeah, game over. Yeah, not going to happen, right. So I think it gives you somewhere to begin this process of exploring, what are the limits, what are the capacity constraints you have, et cetera. And ultimately, as I mentioned earlier, I think it's a talent thing. Yeah. So if you're an allocator, what's your strategy? Buy or rent? Are you going to buy talent and bring them on board and bring them into your own firm? Do you have the infrastructure to support that? What kind of technology do you have? Is it world class? Is it as good as, all the other funds out there? If you're not going to buy and you're going to rent, you hire other hedge funds.
Yeah.
Well, you go through that same exercise because, again, retaining, developing talent, world class talent is it's tough.
Yeah.
It's really hard.
Yeah. And in your experience hiring this talent, did you find that there was specific questions that you found intuitive or insightful as to try to assess this before you make the hire? Is there anything that you can point to as far as common characteristics amongst talent?
So I have a lot of friends in the special operations community.
Okay.
And I've talked to a few of the people in their selection who are involved in the selection process and the psychological part of that selection process. And it's very hard. And they can put those people through things that we can't put them through. We can't put people through some physical test and see if they're going to crack or not, get close to dying and crack. We can't do that. They can. And they still have a difficult time identifying, what is it about a specific person that allows them to be as resilient as is needed to, be in that kind of occupation. I think resilience is the most important thing. Going back to some of the data I talked about earlier, you're not right a lot. So being able to feel comfortable with that is really, really important. And I've been involved in the various kind of development programs, investor development programs at my firm. And, what I've argued to people is like the faster you get comfortable with the idea that you're going to be wrong a lot, you're going to get way ahead of the game, because that's what this business is about: being resilient, being comfortable with things not working out, and having a plan when they don't work out. So, it's all about that resilience thing. And that is hard to measure, and it's tough.
Yeah.
It's tough. There's I read a book by Nicholas Taleb called Skin in the Game. And it was, kind of interesting, and it provided some insights into this kind of stuff, who's resilient, and who has what it takes to do well in a very, very competitive and draining environment, because the market tells you every day whether you're right or wrong.
Yeah.
And, as much as you try to not take things home, we're human beings and we do.
Right. I mean, it's referred to as the Coliseum for a reason, right? It's every day you're
exactly
stepping into the ring and
exactly
you could come out pretty bloody and battered.
And, I know myself, our score every day is on the board, right? Everyone sees what my performance is across the firm.
Yeah.
And, you walk into the elevator and you see somebody who's in business development, you've had a rough month, and they're looking at you saying, wow, you suck, right? And it.
Yeah.
So you have to be comfortable knowing that your score is on the board every day, and everybody sees it. You can't hide.
Right. Yeah.
And for me, that's the clarity that I always loved. I love that clarity. My life was defined by one line. It's really simple. Is that line going up? Right. And when I first started working, I was in research, and I really didn't enjoy it at all, because it's tough to measure.
Yeah.
And when it's tough to measure, you have this ambiguity. It's a double-edged sword, though.
I've never spent any time on the trading side, but it seems like there should be a better way for portfolio managers to kind of not put so much pressure on themselves and separate themselves a bit from the day-to-day. And some of it depends on holding period and horizon and whatnot. But knowing myself, I feel like that would be a very difficult type of a grind to get used to. Have you always been results oriented and driven by kind of real time or close to real time results, if you will?
Have I been results oriented? I loved playing sports as a kid, and I liked the competition, and I like to win. I think most people do. What drove me to the industry was, to me, it's the closest thing to alchemy on the planet. You, especially on the quant side, you come up with an idea, have a thesis about how things work. You build some analytics around it. You can test it, simulate it, and then you attach capital to it, and lo and behold, it has the potential to generate PnL. I mean, how wild is that? It's insane. And so, it's a fascinating industry, and, you're really not constrained by, any creative limits. You can just kind of think about stuff and come up with new ideas. So it's fascinating that way. But, I like the idea of having a scoreboard and know where I stand. And again, it's a double-edged sword.
Yeah.
I just don't know. I don't know how, and this is what makes it difficult, how you limit or reduce that pressure on people, and I think it's that pressure that actually excites a lot of people. I watched the Tom Brady roast. And the guy's insane. He was like, he's so much better than everybody else, and didn't have all the physical attributes, but he loved that being on the big stage in the big game. And think about how many late game comebacks he's pulled off. It's incredible.
Yeah, it's not a coincidence.
It's not a coincidence, and some people are drawn to it and others are not. And it doesn't mean that, people are better than others. It's just some people are made for certain things,
Yeah. As a Steelers fan, I hate reminiscing about all the times that Tom Brady made my Sundays miserable. But we could spend another podcast on the roast. I thought it was great.
It was pretty funny.
It was great TV. But John, this has been great. We'll cut it there. As we said before, not a question that we're going to necessarily put a fine point on today, but lots to think about. I think it's something that the industry thinks about a ton, and this has been great to start the discussion around it. So we thank you for your time, and
thank you.
Look forward to continuing the discussion.
Thanks.
Thanks.